Good morning, ladies and gentlemen, Your Excellencies. Hello, everyone. Thank you for being with us on the 19th Jibka. It's good to have Sheikh Nawaf again this year for the second year in a row. Without further ado, let's get right into it. Sheikh Nawaf, we've heard a U-turn made by the IEA, the International Energy Agency, lately when it came to their long-term demand scenario forecasts. They now see demand for oil continuing to grow until 2050. We've also seen in the past year as well a reshuffle of strategies from some of the big international oil companies such as Shell, BP, refocusing back on their core business of oil and gas. How do you see this new consensus forming around oil demand long-term forecasting?
Thank you very much, Naser, and thank you to Jibka for having me again, and also to the Kingdom of Bahrain for excellent hospitality as usual. To the IEA and their latest forecast, I would say welcome to the club, welcome to reality, and welcome to the world at large. Previous pronouncements by the IEA really made no sense from a business perspective, from a practical perspective. To call for no new investment in oil and gas was bound to set the world up. Had the world heeded that call, that would have set the world up for catastrophe. And so I would say, welcome to reality to a certain extent. And let's not read too much into the latest forecast. It is only one of the multiple forecasts that they have. But it does start to recognize the reality that there is no substitute for oil and gas. When we look at energy demand moving into the future, this is even before you fully work in AI and all of the electricity requirements.
Let alone the petchem demand as well.
Let alone petchem demand, exactly. All of that, primary energy demand is forecast to increase by over 30% between now and 2050. When you look at, and it's somewhere 600 and something exajoules right now to somewhere near 900 exajoules, so somewhere between 30 to 50% between now and 2050. When you look at all of the sources of energy, wind, solar, nuclear, even if you bring in coal, which is far dirtier than oil, all of those other sources will account for only about 3/4 of that demand. That last bit of demand can only be met with the last remaining source of energy, and that's oil. So stopping or not recognizing that oil demand will remain strong for the next few decades is really, we lawyers would call it malpractice. And I think that's, I'd say to the IEA, welcome.
Welcome to the club.
Yes.
All right, great. So let's talk about another club that recognizes the oil demand growth forecast, which is the OPEC Plus. They've just recently agreed a new maximum sustainable capacity assessment mechanism where quotas will be based on that assessed capacity. This means that countries that invest in their upstream, they get rewarded. Does that change the calculus for your upstream capex in Kuwait?
No, actually, it actually follows, it catches up to our calculus. We have been firm believers that oil demand will continue to increase, and the statistics I gave you just now, and saying that that last quarter of the energy mix pie is going to be oil. If you look at that pie, that last quarter is about 100 million barrels of oil a day, which is quite similar to what the world is producing
what we have today, yeah.
But with decline rates at, let's call them 3 to 5% per year, that's 3 to 5 million barrels of oil a day that must be replaced just to keep production where it is right now, let alone satisfy increasing demand. And that's why we in Kuwait have always invested and have made it paramount for us to invest through the cycle so that we can have that demand ready when it's needed. And that is, I can proudly say that in the last three and a half years that I've been in this position at KPC, we've increased our production capacity by over 20%, simply by doing a simple thing, unlocking an arcane procurement procedure in Kuwait that kept us from just having the surface facilities that were able to accommodate the massive resource base that we have. So the OPEC Plus agreement, as you say, rewards those who invest, and the reason I think they did that is a recognition that we should be investing in upstream capacity. We in Kuwait are spending between $9 and $10 billion a year in capex for upstream activities. That will take our upstream capabilities from the current 3 or so million barrels of oil capacity a day to 3.2 very quickly, and then moving us to 4 million barrels by 2035. And that's something that we will invest all the way through. We'll also increase our gas production capacity to 2 billion scuff a day, and we can talk about what we do with the gas.
Absolutely.
Absolutely. But from that mechanism, it is a reward for those who invest, and it is also a recognition that with a lot of international oil companies and some of the NOCs outside of our system, there's been a lot of underinvestment in capacity. And you saw the effects of that as recently as a year or two ago, when the world needed more oil, and it was only a few countries in this region that were able to provide
satisfy that. Yeah. All right, so let's move on more downstream now. Given that we're in Jibka, a lot of the people here, and I see a lot of current and ex petchem leaders in the crowd here today. In Jibka last year, probably, you were here as well, people were thinking of 2025, maybe this is the year we're waiting for a recovery in the petchem industry. This did not materialize. What are the reasons of this downturn? And do you think it's more structural than cyclical this time? And what do you think, how long do you think we're going to be able to chip away at this excess overcapacity? How long would this process take?
Well, I think last year my view was this was a structural shift in the market and not a cyclical downturn. The reason being that you're seeing the overhang in ethylene supply. There's a massive buildup in ethylene capacity. And the overhang in the market is somewhere around 15% right now. That's really quite large. When you look at it, needs to get cleared out. And that has taken run rates in those facilities from the usual 90% plus to below 80%. And when you're running your facility at below 80% capacity, there's really no profit to be made, if any. And you're seeing a lot of, as His Royal Highness Prince Abdulaziz bin Salman from Saudi Arabia says, a lot of herding going on. And that's happened in the petchem industry. He was talking obviously about the oil industry. But in the petchem industry, we're seeing that, and we're seeing that the net effect of that then is that you're going to have to take off oversupply. And that oversupply, from our estimates, translates to about 20 or so world scale crackers that are going to have to leave the market. And that's going to hurt quite a bit. And it'll hurt those who are disadvantaged in feedstock, disadvantaged in price, and disadvantaged in location. Luckily, we in the Gulf, all the way through the Gulf, have all of those advantages. We've got the gas advantage and the feedstock advantage, even then we've got the naphtha advantage as well. We've got the location and the cost structure. But I think a big query out there will be obviously China, as it always is. whether you're talking about oil demand or even petrochemical demand. If you look at Chinese growth, and here I'm looking at a normal 5% growth in China, that translates to over 1 million barrels of extra petchem demand and into the future between now and 2030. But cut that in half. If Chinese economic growth is not at 5%, if it's at 3%, for example.
5% is the target, and it seems to be a little bit out of reach.
Well, that's the thing.
In the short term.
5% is the target. So if you model 3%, then you're talking about somewhere around half of that incremental demand, maybe about 40% of that incremental demand evaporating. That makes a huge difference in the capacity and the prices, obviously. So what we're doing through all of this is making our investments in both domestic investments in petrochemicals, such as a new olefins train, and we can talk more about that if you like, but also making investments outside Kuwait, and we recently announced a joint venture partnership with Wanhua Chemical in China, where we get into 25% of the chemicals business, petrochemicals business at Wanhua. Why is that important? Because it is a more fully integrated basis on which we operate, and KPC has always operated. We started this in the 1980s when we went downstream all the way through to the Kuwait service stations in Europe. We're trying to move now more into downstream operations in the petrochemical part. Wanhua, for example, was a very good and reliable business partner for purchases of naphtha and LPG and whatnot. But in this case, we had a discussion with Wanhua and said, look, we're not going to keep supplying just as a supplier unless we start getting into downstream businesses of that, and they openly welcomed us into that, and that actually creates new partnerships for us, where we can take that hydrocarbon coming out of Kuwait, just as we take it into Europe, for example, through our refineries, our service stations, all the way to the wingtip of an aircraft. We want to go all the way down the value chain.
This is the way you're aligning your upstream and downstream strategies. How's the feedstock optimization affecting or impacting either both your decisions on the upstream or in the downstream? You've mentioned that you're finding new quantities of gas in Kuwait recently.
Absolutely. We always used to say that we are oil rich but gas poor. We're no longer gas poor, and that is because we have made extraordinary discoveries of gas. Quite a bit of it has been offshore. We have been producing oil for over 8 decades, almost all of which has been onshore. All of it actually has been onshore, except for the partition zone that we have that we share with Saudi Arabia. The movement to offshore has been new to us. We've drilled 3 wells offshore, and we've had a massive success in all 3 of them. You never see 100% exploration success ratio in the world. It's just a testament to the resource base that we have. And quite a bit of that has been gas, which is exactly what we want. So as we play around with the product mix, if you will, in Kuwait to set up the industry for that product mix, we recognize that we will now have more gas available for industry. And for that reason, we are eager to move towards a new olefins train to take advantage of that position in gas. At the same time, we are optimizing our product slate even on the refining side. We built a refinery in Kuwait, a Zor refinery. It's 615,000 barrels of refining capacity a day. And it was designed, honestly, to provide ultra-low sulfur fuel oil for power generation in Kuwait. Sometimes it's better to be lucky than to be good, because somewhere along the lines of when we were building this refinery, the Ministry of Electricity and Water, in its infinite wisdom, told us that they no longer wanted the fuel oil and they wanted gas instead, which we then had to import as LNG. So we were stuck with a $15 billion refinery. With unallocated product streams. Right when that refinery started working, Russia invaded Ukraine, Russian gas got cut off from Europe, massive demand for fuel oil and distillates into
especially low sulfur ones that
exactly.
you produce at the
and this is world class in terms of the product stream. So we optimized that and we took advantage of it. So my point here is we've always been traders in Kuwait and Bahrain as well. I mean, especially along the Gulf, we've been the international maritime traders well before the oil was discovered. And we draw on that past to take advantage of of positions as and when they come. So now we're finding more gas in Kuwait. So we're going to make those investments that will take advantage of that gas.
Sheikh Nawaf, let's talk about these investments. So looking at your domestic downstream investments, you have the Olefins 3 project, which is a bet on the feedstock optimization. You have reports that a Zohr refinery petchem complex project is expected to make a breakthrough announcement end of the year, early next year, plus the new Olefins 4 train, which you at KPC have just approved the availability of gas for and
yes.
looking for partners for that as well. Yes. Could you give us a quick update on that?
Absolutely. When we built the Zohr refinery, the prize, as you say, project was always designed to be a petrochemical add-on, essentially downstream for an integrated refinery at Zohr. It was built instead as a refinery and then left as a separate decision on the petchem side. We're looking at that very carefully right now to determine whether we're in a position or close to a position to take FID on that or not. As we talked about, with a structural change in the petrochemical market right now, you have to be quite careful before you put in billions of dollars of capital outlays for a project such as that. So we're taking a look at that quite carefully. At the same time, though, we've identified that we always had been careful about identifying gas resources for a fourth olefins train. And now with the discoveries, with our comfort right now on where our demand is going domestically in Kuwait, we're able to allocate the necessary gas for olefins 4. And that is, the natural way is to move through partnerships. We've done it through Equate in Kuwait. We are doing it in other locations around the world. So we're naturally look for a partner, or otherwise we might go alone on that.
Okay, so decision in 2026 maybe on that
I won't
front?
put a time on that decision making, but certainly we're weighing that along with, like everybody else in this room, looking at the current market and trying to ascertain, if by the end of the decade you expect the market to pick up, in which case then now may be the right time to build.
Okay, so talking about partnerships, one of the largest GCC JVs actually is your partnership with Oman OQ in the Duqm refinery, which is
It is the largest cross-border JV.
There you go. So we're talking about more than 200,000 barrels per day. It's an $8 billion project. There's a consideration for a petchem add-on as well on that. So what's happening there?
Exactly the same point. And that is, this was a complex that was originally intended to be built as a integrated refining and petrochemical complex, such as what we have, for example, in our joint venture in Vietnam. Instead, for whatever reason, it was decided that it was to be built as a refinery first and then a petchem afterwards. So now we're in the phase of having started up the refinery, and honestly, it really was a flawless startup on the refinery, and I really applaud the team, the joint team between the Omanis and the Kuwaitis in Duqm who started up that refinery and has been keeping that up running at really fantastic uptime. We're looking at how to integrate the petchem side of it. It probably will not be a fully integrated refinery because it probably makes more sense to take advantage of gas in Oman. As you know, the Sultanate has tremendous gas resources, whether it's Khazan or other fields in Oman, and we know those all very well. We can take advantage of that to build out a petchem element. We've been looking for a partner, but if not, we're very happy to do this at 50-50 between OQ and KPC.
All right, so at KPC, you're looking to expand your petchem portfolio. Do you think it's cheaper now to expand that portfolio through greenfield, brownfield expansions? Because we still have time until the market really recovers, so you have the time to build that out. Or do you go and expand through acquisitions, given that current valuations are depressed? Which is a better strategy?
The answer is yes, both, honestly. Okay. And that's very simple. You take advantage of the positions that you're presented with. On the acquisition side, as I mentioned, we made an acquisition in China through a joint venture, and this is not taking advantage of someone else's misadventure or misadvantage. Instead, it is actually building on with a reliable, stable partner a new business, and that's what we're doing with Wanhua in China, and we're actually considering and actively looking at other opportunities that are quite similar in China and other places around the world. So the acquisition vehicle is open for us. Honestly, when you look at what might be distressed assets, there's a reason they're distressed. And they're distressed probably because they lack one or more of the three things I mentioned at the beginning. So they may not actually be the best acquisition. Instead, you make your play with stable long-term partners, and that's essentially what we do, and we try to tie that in with the supply situation that we have. So we are supplying LPG, we are supplying naphtha. We want to take that feedstock and see it move down the stream. And that's on the acquisition side. On the new build, on the greenfield, we in the Gulf have a separate advantage. I've worked in other places around the world, and I'm always reminded, our friends in Canada call it the Alberta advantage. In the Gulf Coast of the United States now, after shale gas, that's another advantaged position. And certainly we took advantage of that, to use the same word again. We built out, through Equate, an excellent petrochemical facility in the Gulf Coast of the United States, making use of the position for the good position in gas in the Gulf Coast. But we have that here in the Gulf. And having identified the gas resources in Kuwait, which is completely a new and game changer for Kuwait. We're always worried about not having enough gas. Now, we're more comfortable in making these
We're seeing this push for gas. I mean, in Kuwait,
yes,
in the UAE, in Saudi Arabia, a huge push there.
We're not going to, by the way, we're not going to do what others have done, which is build out an LNG facility and export. No, we're still importing at this point. But we haven't even touched by the way, our unconventional resources in Kuwait. We have a layer of unconventional resource that actually spreads across the entire geography of Kuwait. It's relative, the same thickness, same permeability, and it's really quite exciting. But we haven't really touched that yet. We're keeping that for later. But we do have that position that where we can allocate gas and build out facilities in Kuwait. So to the extent that we can actually build out more and invest more in our home country, obviously that takes priority. It creates GDP, jobs, and it creates exports.
On creating or expanding in Kuwait, does KPC, having the advantage of being a low-cost feedstock producer, will it continue to double down on that advantage in the hope of ceding market share from high-cost producers, or will KPC move into differentiating its petchem offering, moving into specialty performance chemicals and away from your commodity polymers?
I love your questions because the answers to all your questions are yes.
That's an easy one. I'm giving you the easy way out.
No, it's honestly, we're looking at both. You know, we've always been quite strong in the basic chemicals. We have a very good position in monoethylene glycol. We've got another very good position in aromatics, but we would like to assess the opportunities for more specialty chemicals. But again, we'll take the opportunities as and when they arise, and we'll take whatever opportunity makes the most economic sense for us. You know, I want to build this in maybe with a short discussion on sustainability before we cut out, because we're convinced that the demand for petrochemicals, as I said, as much as I said about oil demand being something of which something in which we have great confidence, petrochemical demand probably even more confidence in that, because as population increases, income levels rise, people demand more products, and every one of these products always has some petrochemical element involved in it.
Of course.
So try as much as you can. You cannot survive quite literally, because you can't be in an operating room in a hospital without having the surgeon touch everything that turns out to be petrochemical based. So we have to recognize that in the future that demand is going to be there, and we will invest into it. The other question is, how do you do that while offsetting the carbon emissions?
In a sustainable way.
In a sustainable way. And how do we do that? It's very simple. If I look at our do-nothing case, where we don't do anything on greenhouse gas emissions, we will, by 2050, we will be emitting somewhere around 58 million tons of CO2. So how do we take that down to zero? We've already announced that we will be at net zero Scope 1 and Scope 2
2060.
by 2050.
50.
The country, the state of Kuwait is 2060, KPC is 2050.
On Scope 1 and 2.
On Scope 1 and 2. So take your 58 column, million tons per annum of CO2 that would be emitted if we did nothing. 45 to 50% of that goes away simply by us adopting CCUS and CCS, carbon capture, utilization, and storage, and carbon capture and storage. We had always been moving towards carbon capture, utilization, and storage. We wanted to utilize the carbon to re-inject in reservoirs that were oil producing, to replace the gas that we were injecting to support oil production and reservoir strength. We found that that is an expensive endeavor, simply because the carbon gets recirculated and recycled back up with the oil production, and carbon and steel don't get along very well. There's a massive corrosive effect of carbon on the metallurgy that requires either retrofitting or massive new investments that make the CCUS at current technology not economically effective.
So you want to strike out the U in the CCUS?
We wanted to pursue the U as much as we could, but then we actually discovered an underground reservoir that normally you would store carbon in a depleted reservoir. We don't have any depleted reservoirs in Kuwait. It's a good problem to have. But alhamdulillah, our very first well that produced in Kuwait is still producing today.
Mashallah.
So we don't have that those reservoirs in which to store the carbon. We found instead new formations, and we found a formation that has a four-way closure, absolute dream of a formation from an engineering perspective, and it can handle 1 billion tons of CO2 injection. So that could be sequestered for all time. And that translates to over 35 years of CO2 emissions by KPC as a whole. And that's just, originally thought that that would take us down 50% of that 58. That can take all of it, honestly. But we're not going to do that. We're still going to do the 50%. Another 25% of the remaining 50 is solar power generation. Right now we produce we use 1.7 gigawatts
in your operations
of energy of power in our operations. We're going to build out 2 gig of power through solar, trade it with the electricity ministry, and then essentially take our scope 2 emissions down to 0. So that's 25% right there. And then the last 25% is efficiency and afforestation, which we're pursuing through mangrove plantations. So we really have a very credible and easy path to get to net zero by 2050. So.
Well, on that sustainability note, I think that's all the time we've got. We're going to end it there. Thank you very much. Sheikh Nawaf Al Sabah, everyone.
Thank you.